Okay. So partnership, ordinary income or loss. Remember we've got, and we talked about this in chapter 8, when we were talking about the Schedule E, that we have ordinary income or loss and we've got separately stated items. So ordinary income or loss is, if you just think of it in terms of what would be on the Schedule C, if it was a sole proprietorship, that's what the ordinary income or loss is. It's all of our income minus our expenses, right? Our ordinary and necessary expenses. So, and like I said, the same rules apply to as far as what is income and what is expense. So all the ordinary, necessary, and reasonable. Okay, so all those rules apply. Now, one other thing that's kind of different about partnerships is partners do not earn salaries from partnerships. If you are an owner of a partnership, you do not receive a salary from the partnership. That doesn't, however, mean that you can't receive cash from the partnership, and there are a couple of ways that you can do that. One of them is through guaranteed payments. Guaranteed payments act like a salary. In fact, they have to be fixed. They cannot be dependent upon the income of the partnership. So they can't say, oh, we'll pay you this salary, partner A, as long as we make $100,000. Then we'll pay you $10,000. It can't be that. You get the $10,000 regardless. So it acts like a salary, but it's not a wage. It's not reported on a W-2. Guaranteed payments to partners are for services, though, okay? The guaranteed payments are deductible to the partnership, but they're also taxable to the partner. And it's taxable as self-employment income. Okay? But the beauty of it is that the partnership overall gets to deduct it as an expense. That's a little bit different from sole proprietorships, where if an owner takes money out, yeah, they don't pay any tax on it, but they don't get a deduction for that as a wage, as their own wage. They're just taking their own money out that they've paid tax on. But for guaranteed payments, it's in exchange for services. It has to be calculated without regard to partnership income, but it is deductible to the partnership. Here we've got Junie is 20% partner in DJ Real Estate. He does work for the partnership. He receives $1,000 a month for his services. The $1,000 a month is a guaranteed payment. The partnership gets to deduct it from ordinary income, but Junius is going to have to report $12,000 of self-employment income to him. I'll show you where this shows up on the K1. They always show, it always shows up on the K1. So there's a spot for it. Donna is an 80% partner. She also works for the partnership. She receives a monthly payment of 50% of the net income for the month. This is not a guaranteed payment because it is dependent upon the income of the partnership. So it has to be a set amount, okay? You get it whether, as long as you provided services, you get it whether or not the partnership earned income. Now, that's, yeah, go ahead, Lisa.
So some partnership deeds, actually the partners agree to take salary like every month.
Mm-hmm.
So is it like for tax purposes, it's considered as a guaranteed payment, not as a salary, just for tax purposes?
Yeah, as long as it's a set amount, and as long as it's an exchange for services. So it's not, but no, that's okay. So it's self-employment income. They're gonna pay Medicare and Social Security tax. They're gonna pay self-employment taxes on it. The individual partner is going to pay the payroll taxes on it, or I shouldn't call it payroll taxes, the self-employment taxes on it. Did I answer your question?
Yes.
Are you sure?
Yeah, I just want to know, like, it's not considered as salary.
It's not technically a salary, because a salary would be some sort of wage, would be some sort of like employment. Salary kind of implies employment, and as a partner, you're not an employee. The partnership itself can have employees, but the partners are not employees of the partnership. Okay, but they get money out through a guaranteed payment. It has to be in exchange for services, and then the partnership can take a deduction for that. So, for example, what's this? Let's say we have we've got 3 partners, A, B, and C. These are our partners. So the partnership had income of $100,000. Partner A provided services to the partnership and gets a salary of $10,000. I called it a salary, I'm sorry. Receives a guaranteed payment of $10,000. So now, this is our ordinary income for the partnership. This is just the partnership. If they are equal partners, each of these partners is going to have ordinary income of $30,000. But partner A is also going to have self-employment income of $10,000. So they're going to have to pay tax, self-employment tax on that $10,000, plus they're going to have to pay tax on their share of the partnership income. Partner B and C, if they don't have a guaranteed payment, they don't have that additional $10,000. Okay? But so partner A got the benefit of being able to reduce his ordinary income by $3,333, but he's now got to add $10,000 onto his income. Okay. These are the only items that are reported both as a deduction and as a separately stated item. So I'll show you on the K1. This is what a partnership return looks like. Again, it's very much like a Schedule C. It's like an income statement. Okay, the first page is like an income statement. This is where all those expenses would go. Now the schedule, and then really several pages in here are just a bunch of yes or no questions about partnerships that have to do with complex tax law. And about the ownership, who owns the partnership, yada, yada, yada. But the last page, well, not the last page, second to last page, is the Schedule K. This is where the separately stated items in total are reported here. So this is the Schedule K. This is on the 1065. Each of these separately stated items are then distributed to the individual K1s based on the individual partner's ownership percentage. So for example, if we had ordinary business income here of, well, let's see, we have another spot for guaranteed payments, $10,000. So we have ordinary business income of $100,000. $100,000 would be listed there. Guaranteed payments would be $10,000. So our, let's see, how do they do this? Rental income, A and B. I don't know why that's, anyway, so these all items are all in total for the whole partnership. So like interest income, the entire partnership. What did the partnership earn for interest income? It's going to be listed there. And then on the K1s, so you can see that's related to the name of this schedule. The K1 is what each partner receives individually to report their share of the partnership income. So everything on this Schedule K is divided up then amongst the partners. And I'll show you what the K1 looks like. We've seen balance sheet. There's always a balance sheet that goes along with the partnership return. Oh, they're not going to give me a K1? I don't know. 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 I don't to show you K1, show you how that relates to the Schedule K. By the way, this is, you can always go on the IRS website too and look at these things if you're, like, if you want it explained to you in a different way. This is- K1, not K1. So you'll see, when we look at that K1 here, ordinary business income in total corresponds on the partner's K1 with line 1 here, their distributive share of that ordinary income. Guaranteed payments for services, so this is gonna go on, only on the K1 of the individual who received guaranteed payments. So partner A, in our case, would have $10,000 listed under his guaranteed payments. The total of the ordinary business income and the guaranteed payments is the amount that's going to be, in total, be subject to self-employment tax. As long as they're a general partner. Let's see here. So each of these items you can see here, gross rental income 3A. If you look at the K1, other rental income. Let's see, dividends and dividend equivalents, 6A, ordinary dividends, 6A, ordinary dividends. So everything on here, like I said, this is the total for the whole partnership. All of that gets reported on the K1s for each partner, whatever their share of it is. Let's see. Real quick, I want to try to get this done. So, depreciation is the same rules for a partnership as it is for Schedule C. One difference, though, is that 179 expense deduction. Remember that 179 expense deduction is limited based on individuals. So even though the partnership and certain partners may be able to deduct 179, other partners might not be, because they combine all of their Section 179 deduction together. So if they have multiple businesses with a lot of 179 expense and they exceed that limit, then they may not be able to the individual partners may have to carry over some of that 179. Let's see. Health insurance premiums. Health insurance premiums that are paid by the partnership are considered to be income to the partners. And the partners will pay tax on that because partners are not employees. They cannot exclude from income the cost of their health insurance premiums. So the value of the health insurance premiums gets added to their income for each individual partner, but then they get to take that self-employed health insurance deduction. They get to turn around and back it out as an adjustment to their income. And we talked about that in chapter 4, those adjustments. You remember that? No? Okay. Thank you for your honesty.
I will when I see it.
Okay. I know you guys are probably maxed out. I'm maxed out too. There is a interest expense limitation, so they can only deduct so much in interest expense. It's only for businesses that have gross receipts over the prior 3 years of over 27 million, average annual gross receipts. So larger partnerships, yeah. Let's see. All right. What I really wanted to, and then there's the list of the ordinary items, things that would be calculated and entered into line 1 on that K1. So that's essentially what our net income is. And then all of the separately stated items, because they're going to affect each individual partner differently. Okay, and we went through those a lot in chapter 8. All right, questions?
Well, not about this, it's about tax act. Could we have like through Thanksgiving to